Alright, good morning and welcome to Economica. I'm glad to be back with you today. And yesterday we did a little walk through some of the macroeconomic variables of the United States economy, and I was aware there was some Federal Reserve decision, but I didn't know it was while I was recording and starting all the stuff, because I couldn't be bothered to have a look at the economic calendar. So today we are starting from the page of the economic calendar, and yes, this is 18th of December, and yes, yesterday there was the where is it? Oh yeah, it is. Yeah, it was the Fed decision, and we knocked off 0.25% from the federal funds rate, and we can see here the interest rate projections. And this, if you go and watch the video that I uploaded yesterday about will the Federal Reserve make a monetary policy mistake, we just saw that our prediction model just gave us a very similar path, 4.5 and eventually 4.25% federal funds rate in the coming months and quarters. So I had to say that yesterday I was forced against my will to follow up on the FOMC press conference, and it was very, very interesting. And yes, I had the pleasure to learn a lot of things about what are the framework, the working framework of the FOMC, how they are forecasting the economy, and they tried to explain also very interesting stuff for to journalists. I mean, these are more complicated things. But anyway, let's go forward. I don't wanna. I'm back today because I went through the data again, and I said I was not satisfied. And I went back through the data again, and I decided to expand the VAR model with the same variables, and I will show you also a method that can be utilized, can be implemented to find what are the disequilibrium between macroeconomic variables. So that's when economists or people, academics or people who do this work, they try to understand if there is disequilibrium between parts in the economy, and how they have to implement their fiscal policy or monetary policy in order to achieve their objectives. So let's start with something simple, and because as usual I didn't know that today, which is Thursday, we have the Bank of England going for 1 p.m. Interest rate decision, and this is very difficult for them, because I think yesterday we had some the inflation data from Great Britain, and we see that core inflation has been increasing from 3.3 to 3.5, and we have an inflation rate. This is the inflation rate month on month, which is decreased by 0.5%, but the year-on-year reading, it's up from 2.3 to 2.6. So we see that the frequency of variables of observations, they behave in a different manner, whether it's monthly frequency or it's a year-on-year frequency or it's quarter-on-quarter frequency. And when anybody goes and have a butcher at this the economic calendar, then we see some data. We try to figure out, we try to understand, but there is basically requires a lot of work to really understand what are the underlying reasons and what are the economic behavior of many economic agents in the economy. I don't know, the manufacturing sector, the many industrial sector, the service sector, the food production, retailers, and so forth and so on. So the economy, it's a multi variable environment, and on top of that you need to try to figure out what is the behavior of consumers, of businesses. So the behavior is not always rational, or it's a follow through on let's say a rational decision, but maybe some people they spend too much, or they save too less. So they save too little, I'm sorry. So I'm trying to give you a broader picture of what really means to have a deep dive in what you see behind this whole series of data, and how fascinating it can be to study all this stuff. Like, for example, on Monday we got inflation data from Italy, and Italy it's generally speaking a country where prices are mostly compressed and suppressed most of the time. So a lot of inflationary pressures, they are always contained, and we see that as a seasonal factor going into Q4 and into holiday season, more spending for Christmas and all that stuff. We see that the year-on-year rate of inflation has moved up a little bit, and we see this is another kind of the harmonized CPI, which is more used on a euro area level, but the month-on-month reading, they are the same, minus it's basically not moving at all. But the year-on-year rate of inflation shows that this year, compared to the past year for the same month, prices are higher. So although we can see on a very rough basis that although the ECB has kept rate at 4.5% for many months, we start to see that the pass-through effect of interest rate, they don't achieve to compress so much seasonal effects of inflation. So these are all nuances in the when analyzing macroeconomic variables and all the stuff, having a clear picture of an whole economic framework that's very complicated, and they are moving, they are constantly changing and moving. So it's I have to say it's very fascinating. It's a very fascinating field of study. And so, for example, then Tuesday, and I want to take what are the most relevant data we had. We saw this week the labor market data in Great Britain, and we saw a unemployment rate that is unchanged at 4.3%, and we see that bonuses like wage bonuses have gone up, so this will create some, it could create some inflationary pressure. So I don't think so. And 173,000 jobs have been added, and it's a bit less than the previous month, which is 250,000, but nevertheless jobs have been created. And we have some public sector payrolls that have been slashed, minus 35,000 and we have a small change in claimant. So there has been an increase in jobless claims. And yes, the average, this is very nice. We have a live update of car production in Brazil, minus 5.2%. This is very useful. If you don't want to waste your time trading the market and losing money, it's something that I strongly not suggest you to do. Don't waste your time with brokers and stuff like that. It's a waste of time. But anyway, then while UK was publishing its inflation data, its labor market data, then we had the inflation data from Canada, and we have retail sales from the United States. This is another very important, relevant point. But retail sales, they went up, and we know that this is a seasonal factor, because we know that in November they have a big holiday time, which is Thanksgiving. So it's a seasonal factor for the US economy, and this can generate some variance and volatility in the data, and this has to be accounted and factored in when you are projecting some a macroeconomic projection. And we had manufacturing production, which is stagnant in the US as well, capacity utilization, and it's more or less is always around 77%, up or down a little bit, but it's more or less is very stable. And red book inventories and all variety of data. Let's have a look at what is the inflation rate in Canada. 1.9%, core inflation 1.6%, CPI median, trim and mean. These are all modified measures of CPI. These are when you want to capture and see the CPI from a different angle, then you apply some different methodology in measuring the overall headline data for CPI. So this is median, that is the trimmed mean, so you take the average and you trim some volatility out. So, and we see that with different methodology you have discrepancies. So normal, like plain CPI basket 1.9, but if we factor out some other stuff or we utilize a different method, we have 2.6, 2.7. Then the Central Bank of Canada will have to decide what kind of inflation measures wants to be the central bank parameter in order to decide what is monetary policy or the level of interest rate in Canada. And yesterday we had inflation data from the UK, which are not a good thing for today Bank of England decision, and it won't be a surprise to me to see basically an hold from the Bank of England. They won't be able to cut rate any further at this moment, but God knows, we will wait when they'll publish their data, their decision, etc, etc, etc. And for example, we see that for producers in the UK, we have this data that the output prices are stable at 1.6%, and on a month-to-month basis, we see that producers they have slightly increased their output prices. So this will be a pass-through cost effect on retail, and yeah, we see retail price index that has gone up a little bit. So these are all very interesting variables. Inflation rate in the Eurozone 2.2%. This is an aggregate of the whole Euro area inflation. Core inflation is 2.7%, and I think the ECB needs to be careful in deciding ECB interest rate, because core inflation it's above the 2% aim, and I don't know what they will decide. I'll leave it to them very gladly, but I mean, you will need a 200 basis point spread to have real interest rate about 2%. So ECB should be at 4%, but they are cutting, so they have some other ideas. And then what do we have today? Well, I'm freezing today. It's very cold here. Yeah, FMC. We know that now Fed funds, the average rate is 4.5. Then you have the upper bound, the lower bound, the repo rates, the SOFR rates, 1 month SOFR curve. There is a lot of things. And yes, today we have we will be waiting for the BOE, and we see that the euro area has a very nice primary surplus in trade balance, 32 billion, 26 billion. This is very good for the overall economy. Okay, yes, and now this explains to me this whole huge volatility that we saw in the Japanese yen overnight, because the BOJ has kept rate at 0.25%. They haven't changed interest rate, and this has basically sparked a huge volatility and sent the Japanese yen plummeting. So this week there has been a raft of central banks' interest rate decisions that they have created a lot of volatility. And yesterday I was talking about, let's see what will be the outcome of the Fed decision, and yesterday evening the whole hell broke loose, and the market sold off a lot, and the dollar was skyrocketing everywhere. The euro broke through 104, going to 103, and you can go and check my video about how to play out the option chain and see how you can deal with euro dollar exchange rate. As for example, we would imply that interest rate differential between the ECB and the Fed, now that we know that the Fed is willing to hold its rate where it is and not cut any further, while the ECB seems very rushing through cutting interest rates. So if the interest rate differential will widen between dollar and euro, we could see the euro weakening, and we probably, I mean, there is no probability assumed at all, but eventually we could see the euro testing parity with dollar and going below parity. So you go and check out my video about euro dollar option chain, how to see the gamma, the delta, the volatility, what are the prices for put option if you want to buy some downside protection and you want to exploit volatility, implied volatility going farther out of the money, and you want to play around with euro dollar 0.99, exchange rate 0.98, etc. You can try and figure out if you can get it right, but I'll strongly suggest you not to do that, but just for curiosity you can go and check option chains. So as I said yesterday, I was not happy, I was not satisfied, and today what I've done, I mean, just right now, this morning, I went through the same data again, and I modified a little bit, and I decided to implement a var model, same variables, same data that we had, but I extended the lag period to 12 lags, so that I can have a broader picture of how previous months, the previous 12 months, have interacted with the impulse response function between those variables, and then we have the step forwards in the chart, so that we can see how the var is forecasting the forward periods for those variables that are interpolated between each other. So I have to say, what do you want to say, Mike? Just a few things. Is that freedom of speech, is it? Anyway, so this data is good. It tells us that the var model, it works fine, it fits well, and to be extra sure, I also operated I went through the codes, and I did triple check at var sock, var Granger, var stable. So I implemented some codes to triple check if the var model is stable, what are the Granger causalities in var models, and var sock will tell you what are the optimal lags. So the var sock told me that it showed me the results. I saw the results that this one, the AIC criteria. Let's see if I can, if I go down, do I have this data? I'm sorry to, these are all the codes. Alright, yeah, here we have it, varsoc, right? You go and ask for a varsoc, and they will give you a burger with chips and cheeseburgers and mayo and extra pickles, because it's a bit of a pickle. So the AIC criteria, it's a Japanese name, Aikiki, I don't know, information criteria. Anyway, so where there is the star here, it tells you that basically the optimal lags are 12, right? And also the FPE criteria, very small value, and it fits 12 lags. But the BIC, Bayesian information criteria, HQ I see they came up with one lag, so I don't need to know what happens the months before and how that goes through the following month, and so it's better to know the previous 12 months, how they have developed through the economy, through the macroeconomic variables, and what are the following periods, how they are going to evolve, what will be the probable outcomes of variables. So var Granger, yeah, we see that the F statistic tests say that Fed funds, they don't interact very well with producer price index, so this is something to bear in mind. var Granger, and var stable told me that the model is stable, true. So I had a very nice output from the machine. These are all the graphs, and let's try and go through the output, because I'm doing it right now, and I didn't have a look before at the lags and stuff, so I will try to figure out on the fly what came out of the model. So these parameters, they are good. It says that these parameters basically tell us that the model fits well, and the data, the outcome data, they are significant from a statistical standpoint. Not all of them, we'll have to find which ones. So let's see what we got. So first result equation from the first variable. Okay, we have here this interesting parameter. So at the first lag, so if for example we have the first variable it's the last observation was the month of November, as I believe. One lag, it's the interaction between October, the previous month, with the observation month. There could be a month, quarter, whatever. So that's one lag. Two lags is 2 months back, 3 months back. So just to give you an idea of how this stuff works through the modeling of the machine and what is it for. So previous months we have a negative coefficient. So if we have 1 unit, okay, 1 unit, you understand, I cannot write for 1 unit. So if we have 1 unit change in producer price index, then after one on the previous month we had a negative coefficient interaction with producer price index for core inflation. So we see that we have an reverse or inverse correlation between core inflation and producer price index. So let's say that core inflation tries to the components of the core inflation basket, they tend to suppress or to dampen what can be volatility or prices, producer price variance, in supply chain costs or that sort of thing. So core inflation tends to, with some lagged period, tends to somehow dampen or constrain producer price index. And this could be a sort of explanation. And lag 2, Fed funds, and we have a negative coefficient. So what we can say is that, for example, in 2 months previously we have a change in Fed funds. This can have a negative coefficient for PPI. So if we have restrictive monetary policy, let's say, this will tend to dampen or to constrain the pass-through effect of supply chain costs that have to be absorbed by producers through their production prices. They have an input, producer price input and producer price output. So these are producer prices for all commodities. These are not differentiated for input or output. So it's for the whole commodity, all the raw materials and stuff that it's utilized for production. And we see that a restrictive Fed funds can have a negative effect on producer price index for all commodities prices. So let's go and see for the other lags. So we have here 3 months period, 3 lags. This is core PCE. It has a positive coefficient, so a positive impulse from core PCE. It has a 3.63 positive coefficient for producer price index. So if we have higher core personal consumption expenditure, so consumption consumers, they tend to spend more for core services or core goods, then this has a positive coefficient for PPI. So producers, they will tend to continue to pass through their increased costs of materials. And this, if this happens 3 months before, so we see how the economy works slowly. So the variables, they don't adjust immediately, but some economic behavior that has happened 1, 2, 3 months or 1 quarter before or 2 quarters before, then it goes through, it filters through the economy, and then other economic agents, other economic variables, they adjust to this thing. And I'm saying adjust because there is a method to see empirically to see how there are these adjustments, and I hope to do this quickly, but it's a lot of data to have lags, it's long. And so if we have a constraint of credit card credit creation 3 months before, we have a negative outcome, a slightly small negative coefficient for producer prices. So a constraint in money supply, it can dampen the pass-through effect of producer prices costs. So and then at lag 4 we see that this is the same as lag 3, same variable, PCE, etc. So this is core PCE, core consumer expenditure. Also 4 months before, there have been a lot of not a lot, but consumers that were spending consistently also for core goods and services, and this has had a push-through effect on producer prices. So if we have producer prices for the last month data is November or December, 4 months before, this could be August or July or August. So for example, let's say PPI last data is November, 4 months before it's August, so let's say August or July. So these are consumer expenditure maybe for July, Independence Day or holiday season, and this has then been has gone through the economy, and so producers have received the input from consumers and they couldn't be bothered, and then they saw the consumer that were spending 4 months before, 3 months before, and so they continue to pass through their inflationary costs for material and basically material for production. So blah, blah. Let's go back and let's see if we lag 6, same. So we see that core PCE, it has a very strong correlation with or co-integration with producer price index, and this is a factor. And when you build your macroeconomic framework, then you know which variable is more sensitive to that variable, so that you can pinpoint exactly how everything works, more or less, although it's very, very difficult. So we see that there are a lot of data to consider. Like 7 months before, we had a positive impulse from credit card creation, and then we have a pass-through effect on a response exactly from this data. So let's say in Q2, between May and June, we had credit card creation, and that has been a factor for producer price index, or to be that I've been keeping high level of prices for and the pass-through effect to retail prices or wholesale retailers. This is a very big data. All right, so lag 8, so 8 months before, so this is early 2024. So we see that the Federal Reserve had a positive coefficient for PPI. So if the Federal Reserve began to cut interest rate, this could have been stimulating for producer price index. I don't remember now exactly when the Federal Reserve started to cut rate, but it could be. I should be more precise. I'm sorry, but we see, for example, that we have dampening effects. Core inflation, even lag 9, it tends to always come out with a negative coefficient for PPI, for producer price index. So core inflation tends to dampen the pass-through effects of all commodities, which is reasonable, because core inflation is mostly core services. All commodities, it would include energy prices and food prices, so they are not the same thing. They don't measure the same variables when they build the whole thing, the whole index, the whole basket. Okay, so let's try and check. I want to go and see which one we want to do. CPI. Let's do the easy one. CPI, right? No. Let's see what. Okay, let's go through money supply, and then I'll go through a PC variable to see. Let's see what does money supply to these variables. Let's see what the impulse of consumer spending does on all the other variables, and then we go through the charts, and then I'll give you another special thing. So money supply. Okay, this is the same thing. So money supply is very strong follow through immediately 1 month to the other, and it has a very strong follow through for Fed funds. So if we have restrictive Fed funds, the month before we see that there is a negative coefficient on money supply. So if the Federal Reserve tends to tends to increase interest rate, to put up interest rate, then the coefficient in money supply it's negative, so there is a restriction on money supply. This happens 1 month to the other, okay? So it's a very near short term. It can be different, or it can vary for longer periods. So this is important to factor in when to consider when observing these things. Yeah. So if we lag 2, right, it's completely the opposite. So 2 months before we have a positive effect. So yeah, so probably Federal Reserve was decreasing interest rates between September and October, and so we had a positive effect on money supply. So money supply was created has been an effect of stimulating money supply, a reduction of interest rate. And also this is confirmed because it lag 2, so 2 months before we have a positive bank credit creation. So we see that there was money supply already happening in the economy, and it's no surprise that we have sticky inflation, persistent inflation, and it doesn't converge to 2%, and the Federal Reserve it's holding its rate cut. No, this is wrong. Sorry, this is not good. It's holding its rate cut cycles just because they want to have more data for next year and understand how things are panning out. So yeah, right. So 6 months before we had a positive impulse from credit cards and all credit revolving plans, etc. Yeah, so credit cards, they are very correlated to money supply, so it's no surprise that there is a positive co-integration between credit cards and the whole aggregate of money supply. It's very reasonable. Yes, 7 months before there is bank credit creation, money supply goes up, and we had this slight contraction, lag 7 for credit cards, but you see the coefficient is very, very small. And okay, so lag 8. So what happened 8 months before is then stimulated money supply. So a pass-through effect of producer price index has generated money supply. So rising costs in acquiring inputs for producers probably has required credit creation for producers to pay higher prices for their intermediate goods or inputs. This is the same money supply correlated 9 months before. This is very nice, and we can go even back 12 months and see that we had a negative coefficient. So there are, what we can highlight from here is that 12 months before still has a lagged effect on the of the outcome variable of the last data that has been collected, and this also basically goes through the forward steps that the VAR model gets out and elaborates. So okay, let's see core PCE. What we want to do? Core PCE or broader PCE? I would say let's do broader PCE, so that we have a broader measure of. If I find it, I would like to find it. They are out there, but we can't find them. It's very super movie. Okay, so let's do core PCE, because I don't find PCE. This is a reason to. Okay, core PCE. Right. So let's see consumer spending for core goods and services. What happens? Okay, first lag, bang, straight off the mark, and we see that this is CPI, so the broader index. 1 month before impulse from consumer spending, we have a positive coefficient for CPI. So core consumer spending, it tends to have a month-on-month effect on the broader inflation measure. Okay. Sorry about that. Let's see if we find anything. Okay, so yeah, what happens? Fed funds. So if we have consumer spending, we have a reaction on Fed funds. Like if 1 month before the Federal Reserve has decreased interest rate, this has a positive coefficient for core spending, core consumer spending. So easing of condition for credit, then consumers, they go out and spend because the borrowing is cheaper. And if 2 months before we have a pass-through effect of producer price index, we have a positive coefficient for consumer expenditure. So it doesn't matter how high our prices, or if there is a pass-through effect, consumer, they still tend to spend, at least for their core goods and services. Right. Let's see if we find anything else. Here we are. Oh, so 4 months before, positive money supply, we have a positive coefficient for core consumer spending. So money supply, yes, it fits through consumer spending. And so 6 months before, producer price index, this is a very similar. Let's go and check it out. Yeah, lag 2, 0.024, etc., and 0.026. So the coefficient is stable. It's quite similar. Yeah, and yeah, this is basically the same. So producer price index, they nevertheless tend to stimulate core consumer spending, even with lagged effect. 6 months before, we see that if we had in the previous 6 months, even if we had an increase of a pass-through effect of producer price index through core retail prices, then we can observe that we can see that even if there is a pass-through effect for core goods and services, then the coefficient is positive. So core consumer spending will continue. there is no contraction in core consumer spending. So let's go forward or backwards. We don't know if we are going forward or backwards in time. This is very okay. So yeah, lag 8 producer prices, they have a negative effect. So if 8 months before, at the beginning of 2024, we had a producer price index volatility, though that translated in a negative coefficient, but going forward, then we saw that nevertheless consumer spending kept pace. So consumers have been keeping up with their core spending, and then at the same time we had stimulus from CPI. So we have an increase in or a change in CPI, and this had an effect on consumer spending. So if we have an headline, a decrease in CPI 8 months before, this has probably stimulated consumer spending. If we have a decline in the broader rate of inflation, and yeah, this is also to consider. And we see that core sticky inflation, I was just thinking about this morning, and I'm not gonna use this time series anymore for my works, because it always comes out with a negative parameter that it's out of skew with everything. And because this is core consumer spending, and I don't know if we have a dampening effect in core sticky inflation. Yeah, this will translate through. Yeah, if the broader core inflation measure is declining 9 months before, this would mean that consumers, for their core goods and services, they will spending less. So it would make sense somehow. But as I said also yesterday, and I will repeat it today, core sticky inflation, if you ever go to this stuff, it's not a stationary time series, so I will not use it, and I don't really mind. So this is the same core consumer spending, yada yada yada, and yeah, 12 months before, negative coefficients for core consumer spending. So beginning of 2024, we know that Q1 is a seasonally weak season after Christmas season. We have winter months, so people, they spend a bit less because it's colder, and etc. etc. We don't go out, we are in a longer lethargy, and we wait for spring to sprang, and like wildflowers into the wild. Right. Alright, so let's see this son of flowers, what they come up with. Okay, so we saw that we can adjust the lags, and we go back in time. Let's say we just invented the time machine, space-time travel, back, forwards. This is great. Then the VAR model gives you periods forward. So because of the frequency of data is a monthly frequency, the periods forwards, they have to be assumed to be 12 months forward, right? And this data here, they have to be considered as a percentage change. So this is exactly 0.05%, 0.10%. If we'll see some strange data, which I hope not, then just don't bother, because nothing is perfect. And so okay, so we see that in the next 2 months we will have a positive impulse function from producer price index, and then the rate of inflation should also follow through and increase, and then the periods forwards they have a forecast of a move down of producer price index, but this is easy peasy. It goes up 0.05 around that 0.06, and it goes down by the same measure, so it neutralizes. It's like plus one minus one, it's neutral. So basically this effect is none in the economy. And then we see that the broader CPI follows through, and then for the following periods, like in Q3 and Q4, this will be from August onwards, then we will have a steady rise in producer price index and inflation. Let's see what happens. So this one here, very similar behavior, up or down by 0.1 and 0.01 and minus 0.01. So this is net is neutral, is zero. So but we see that core sticky, it tends to have a negative dampening effect. So this is very small percentage numbers. And here producers with money supply, it should be stable in the first months, and then we will have a decline of producer prices that should give out a slight contraction in money supply. But then we see the money supply after February and March for Q1 goes strong again. So it will be steady on a rate of 0.1% more or less. Here is slightly close to zero. So there is not the best thing of this VAR charts, that the volatility here it's very contained, so you don't have wild swings, and this is the outcome that you want to have, because that means that you have eliminated all the residual volatility, and you have worked through time series analysis, and you have reduced all the white noise and the volatility, and you come out with some very narrow range and feasible equation results. So this is core consumer spending. It's not varying very much. So let's go quickly, because I want to show you. Let's see what happens with CPI. We didn't see the lags for CPI, so let's see CPI here. Okay, CPI goes up by 1%, 1 unit. This is wild, right? And so if inflation will be going higher in Q1, January, February, producer prices also will respond with higher prices, and then we'll have a decline. And the rate of inflation is forecast to follow down between Q3 and Q4 next year, but it will be on a steady range here. So we will have months with higher inflation that will probably then determine a higher producer price index. This could be also seasonal effects, but this Q4 decline, I don't really agree, because Q4 should be higher inflation months. So CPI response for core inflation broadly positive, and then we have a decline also, it's forecasting decline in 10 and after 8 periods forward, at 10, 12 periods forward. Okay, core spending, it won't be varying very much, up 0.10% and then down in the following months, then up again. So mixed picture of this. And then let's see what happens. Money supply. So let's say that we have declining inflation but negative half percent, which could be reasonable for the first 2 or 3 months of 2025. So less spending, less money supply, less inflation, but then we see that it goes up again and it's stable around 0.2, 0.3% for the following quarter, and then it forecasts a decline, and then it's a rise. So we see that if we interpolate CPI with money supply, contrary to this, we see that in the period between 8 and 12 months, like August and December, inflation tends to go up with money supply. So money supply again is stimulative of inflation, while other factors like producer price index and core inflation, they can have a dampening effect. If we have in the previous periods, if we have a pass-through effect of inflation into producer prices, then probably if producers have incorporated all the excess cost from the supply chain in the fourth quarter between Q3 and Q4, then you tend to have a dampening effect because all the pass-through cost has been incorporated in the beginning of the year, in the first 2 quarters of the year. So this could be an explanation of what happens when there is a co-integration between inflation and producer price index, or inflation and core inflation. But if we do a co-integration between inflation and money supply, we see that the opposite happens. So the money supply goes up with inflation in the latter part of the year, and probably these are how different variables they work through the economy in a different manner. And this is core. So co-integration here, CPI and core spending, it tends to go down, but it's a very tiny amount, minus 0.10%, so it's negligible on the whole thing, but still it's important, right? And I think, so if we have a decrease in inflation, this would basically serve for the Federal Reserve to say, inflation is converging to 2%, and we can cut further. We can do more interest rate cuts for the base rate, the SOFR rate, and a declining in CPI for the first 2 quarters up to June or July. So this is very interesting. We'll see next year how this stuff will pan out. So money supply, higher money supply, higher producer price index. So generally we're expecting next year a positive impulse from money supply, and all the co-integration factors, they come out with a positive response from the function, and so we'll have core stick inflation rising, core PPI being very high, 0.2, 0.4, and then it sets down at June, and then steady between 0.3, 0.4. This I will have to check it out, because this will lead to higher inflation. And money supply, the broader inflation, we have a stimulus of money supply. So we see that again, what happens is that we have declining inflation, right? And then the VAR model tells you, if you have a declining rate of inflation, then the Fed funds will follow through and will be cut. So you have a cut in interest rate. So the borrowing rate becomes cheaper, right? If the borrowing rate becomes cheaper, then what happens? That money supply is stimulated again. So they work in the opposite way. It's like bond price and yield. Bond price goes down, yield goes up, and reverse. Yield goes down, bond price goes up. So interest rate goes down, Fed funds go down, and then borrowing rate is cheaper, and then money supply, it goes up again. But what happens? That money supply then works through inflation, and then we will have higher inflation. So I want to repeat again the same stupid thing. It seems to me that with all the QE that has been done for the past decade, you can move interest rate as much as you want, but it won't affect the economy, it won't affect money supply, it won't affect inflation as much as past economic framework would suggest, right? So yesterday I was highlighting the fact that if we go and see the money supply, I'll try to give me a minute. If we see the raw data from the money supply, we see that the graph it's wild. So there are a lot of high points and low points for the money supply. So this means that the model breaks, okay, because the stationarity of the model goes out of the window, and I'm trying to find the graph of money supply. I think I'll pull it up from here. Just give me a minute. Money supply, United States M2, okay. Max. Let's see if we can. Oh yeah, change. Okay, change percentage change. Okay. So this roughly. Let's try to. So what I was saying yesterday is when you have this large change, plus 6.4% money supply, April 2020, and then from April 2020, the stock market, it's gone parabolic, 175% up, the S&P 500, yeah? It's not normal. These are not normal returns. These are not excess return. These are not abnormal return. These are out of this world, okay? These are returns that are not normal at all. They are out of the moon, out of the planet Earth gravitational pool that keeps us on with our feet well anchored on the ground. And then so when you have this change, big change up, big change down, not so big, plus 6.4 and minus, the bottom has been minus 1.2, so not so much money has been taken out of the economy with quantitative tightening, because then we see that total bank credit and credit cards, they have continued to generate credit, but through different channels, but also the fiscal schemes, etc. But what I'm pointing out is that when you have this thing and then you go through the data, the model breaks, because the spikes and the dips, the peak and the troughs are so wide that the model breaks. So the machine works through all the data, but when there is this large variability, the machine, basically the econometric model, cannot properly concatenate the previous data with this large wide thing, and then the forecast or the co-integration of variables, it doesn't work properly. there is more uncertainty. So I like to repeat this thing, because we see, to explain again, that inflation goes down. Okay, let's cut Fed funds, but then what happens? That the model breaks through, because it breaks through in which sense? That we cut interest rate, then the outcome is more money supply. But when money supply is stimulated, then inflation goes up, okay, which is the opposite that we see here, that inflation stays down, right? But then we see that inflation has a positive impulse, and then Fed funds will follow through. So what are we gonna do? We're gonna raise interest rate again. Why? Because we cut Fed funds, because inflation is going down. Then let's print some money. Let's give out some credit cards, or let's do some private credit, or whatever you like. And then inflation goes up, and then it stays up all year, and then all of a sudden, after June or July, you say, oh, what happened is that inflation was down, and then it's gone up again, and we'll have to dial up again the interest rate. So that's why there are these factors that work, that go through in the economy with a lag, and then the model breaks up. Let's say it doesn't co-integrate perfectly, and so you have all these discrepancies, idiosyncrasies in the variables that you are considering, and there are different outcomes for the same co-integration, for the same response variable. So yeah, money supply up, and then core consumer spending steady. Yeah, higher money supply and higher core inflation. So what the VAR model is telling me, the charts, is that for next year we will have a consistent M2 money supply, and that inflation will keep up. And this is contrary to having an inflation that is converging to 2%. But now money supply, total bank credit, will be stable. Okay, sometime will be negative, not so much total bank credit. So it could be that for fiscal stimulus will create money supply, or we'll have not so much bank credit creation like in April. Why in April? April is tax year, so basically net people have to you have a flow of money from the private sector to the public sector. So the treasury receives as tax receipts. So you have net outflow of money from consumers, and it goes to the tax pot, the pot of the national tax receipts. Okay, so this could be a reason. And then here, it's all stuff to go through again and again and again and again and again. So what happens is that higher money supply, well, these are very, very tiny changes, and Fed funds should vary accordingly. But this is fascinating. We will see next year what happens, because I will be very I will be waiting to see if the Fed has to pull up interest rate, jack up interest rate again. That will be huge. Okay, so how we can see what are the disequilibrium between variables. When we do a VAR, we do a forecast model, and we want to see what are the disequilibrium and how the variables they co-integrate, how they interact between each other, and how they adjust to an undershoot or an overshoot of co-integration. So to do this, we utilize a Johansen co-integration test, which is also a VECM. So this is error correction model, and this is vectorial, right? Because I can't go to, so basically all these variables, they are considered as they are worked through as vector, as a column vector, so that the end result is a matrix. They are matrices, yeah, and then it works through like a linear algebra with some set parameters. And okay, so I gave you the broader, the loose explanation of how it works. So what it does is that it works through the ranks, okay, and then we see here the test statistic result and the critical value. All right, so if this result is higher than the critical value, then we have co-integration. Yeah, so we have 9 for all the variables. We have a variety, all 9 ranks, I mean 10, because we are counting also 0, of all ranks. They all co-integrate. Okay, so there is a statistical inference between interpolation between variables, between all the variables. And the first part of this thing, let's use the black ink. So the first part of this thing, it's the data output. It's very similar to the VAR model. Okay, it gives you exactly the same. What are the probability, the range, which is 95% confidence interval, and the p-values. Those are those to consider to have a data point that is statistically significant. So as usual, producer price index, if 1 month before inflation goes up, then we have a very positive coefficient for producer prices. So higher inflation, does stimulate producers to pass through these costs. Okay, but then this econometric model, it gives you another an additional variety of data, an additional elaboration output, and so it gives you a alpha and beta coefficient. Okay, so EC, EC1, EC2, EC3, EC4, and that, it picks up all this stuff, right? So these are all the error correction periods or lags, right? And yes, you have the usual coefficient, and the p-value will give you the parameter to see which coefficient it's significant or not. And for example, if we want to read this third lag, we have an error correction here, so the alpha parameter, right? So what it says is that the producer price index, okay, let me loading coefficient for the PPI equation. So okay, so what basically this data helps you to understand is that at third lag, the PPI is an error correction, this factor, this coefficient, and this means that the PPI is in disequilibrium with the other co-integrating variables, and the coefficient is this one, and it tells you the alpha parameter. It tells you the magnitude and the speed at which there is the convergence to the equilibrium. And the negative coefficient, it tells you that basically the variable is below equilibrium, so it wants to converge to equilibrium when co-integrated with the other variables that you are considering in the whole macroeconomic environment. But instead, when you have a positive coefficient, it tells you that the variable is above equilibrium, and that coefficient, it tells you the magnitude and the speed of the error correction from the disequilibria momenta that the variable has. Okay, so just for example, we have a lag 3, so we have a disequilibria for a PPI when co-integrating with the other factors. The alpha parameter tells you that when the factor, the coefficient is alpha is larger than 1, right, or larger than -1, then it means that the magnitude, the speed of the correction and the push through to equilibria, it's strong, it's consistent, it's a very rapid effect. So this means that this variable tends to adjust quite rapidly if it's basically it's undershooting its equilibria momenta with other co-integrating factors. Okay, so I'm trying to explain you these things, I'm learning it along with you all, and I hope that you find this stuff interesting, although it's very it's for a few people to go through these things. Some people, they will find it boring, some people they will find it interesting. I find it very interesting, and but they are not easy to understand. So let's see what if we have here. Okay, so you see, free, we have a parameter to consider for the same variable, producer price index at EC6. We have a large, very large coefficient. So there is 6 months before, let's say, there was a disequilibria momenta for the producer price index. It was below equilibria, and then it has converged to equilibria by this coefficient, right? Let's see. No, sorry. I'm telling you something that is wrong. Forget everything I told you right now. Forget everything, right? Because this is the p-value. This is too large and it's bollocks. Sorry. Okay, so the p-value must be smaller than 5 or -5. So this one is to consider. Okay, 9 months before, this equilibria, we have an overshoot in PPI was higher than the equilibria, and we have a correction factor coefficient of 0.09. So it's a small coefficient. Okay, forget about this. Forget about it. Just totally forget about it. Don't consider it. Okay, let's see. Alpha parameter for core sticky inflation. What happens? What do we have here? I think I'm analyzing it the wrong way because this is... Okay, let's do it again. I'm learning right now. So, p-value, this one. So, for lag, positive coefficient. So, we have higher equilibria momenta for core sticky inflation, and then it adjusts to equilibrium by this coefficient. P-value, so we have here an error correction, which is very it's relevant to how I'm analyzing this thing, because I made a mistake. I don't have to, but I have to consider this column. This was right, okay, and this is to consider, but I'm making a mess. I'm messing about everything. So this is to be considered, and this one, and please forget about this one. Just forget about it. Forget about it. Alright, so we have here a very large adjustment, and here also above equilibrium. This is below equilibria, etc. So core stick inflation. Here we had a negative coefficient, and we have seen also in the other charts that core stick inflation tends to have also often very negative coefficients. So it's core stick inflation, okay? It's a variable because it's not stationary. When it's co-integrated with other variables, it tends to show results that it's undershooting. Okay, so this is very important right here, right now. I'm gonna tell you something very, very interesting, and please listen very carefully, because if we see core stick inflation, this is all macroeconomic blubbering that I'm doing right now with you. Core inflation year on year. Okay, so core inflation has been on a downward slope, right? This is not the same as core stick inflation, okay? But what the concept that I'm trying to convey to you is that, okay, all good, it's all well and good that that core inflation is going down, but when this variable, this whole series of data points are co-integrated with other factors, core inflation, it tends to undershoot. So it's going down, but it's not keeping a equilibrium with other co-integrating factor of the economy, which can be money supply, or which can be federal funds, etc., etc., etc. So I mean, the takeaway or the concept from this is that core inflation is going down, but it's likely to be an undershooting of core inflation, and that if it has to have an error correction towards equilibria, core inflation could reverse trend and go higher, because actually it's undershooting its equilibria for how the other macroeconomic variables are now, right here, right now in the economy. Core inflation is undershooting and probably should be higher. And so we will see in the next months if this is true or it's just a misinterpretation of the data. But we see here also that in the previous months we have a negative coefficient, so we have a negative equilibria, and so core inflation has to pull up to, in theory, has to pull up to be in equilibria, or otherwise this would validate the fact that core inflation has been going down. Okay, so that effectively this equilibria determines that core inflation is going down. Okay, so this validates the fact that core inflation goes down, and the error correction factor, it's a negative coefficient. But I will double triple check what all this stuff means. So core sticky, negative coefficient, okay. CPI, oh, lots of parameters which are very interesting. So we have a negative coefficient here, so we see that negative coefficient undershooting, So this is very, very large. These are all very large coefficients. So alpha parameter, the variable moves towards equilibrium when below the equilibrium level. So when there is a negative coefficient, the alpha parameter tells you that the variable CPI moves towards equilibria by this coefficient when it's negative. So when it's below equilibria, it moves towards equilibria. Okay, so the model, the econometric model found out these error correction models, error correction coefficients. So now I'm becoming tired or doing all these things because I'm becoming confused about this stuff. And yeah, okay. So basically, this is I like to show you this other part 2 of this econometric study about these variables that I utilize to see the possible outcomes in the United States economy for these variables, money supply, Fed funds, etc. And I'm trying to so yes, I was talking about these beta parameters also. The beta parameters, it will tell you, it defines basically the long-term equilibria of the co-integrating factors for the variables that you have chosen. So yeah, co-integrating relation, you see here, let's see some alpha parameter. So when the beta parameter starts here, yeah, so all the beta parameters, they all have very significant p-values, but there is no standard error. So I think, I don't know, I'm not sure that these are very correct outputs, but the coefficient, they're all negative, most of them are negative, and the range, it's negative. There is no zero in between, which is good. But anyway, what the meaning of the beta parameter, when basically is the output of the error correction model, it tells you defines the long-term equilibria relationship between variables, between the co-integrating factors, co-integrating relations. So you input a series of variables in this error correction model, and then it will give you all the lags and stuff, and will give you the alpha parameter, which is very useful to understand at which speed and magnitude there is the disequilibria of the co-integrating factor basically corrects as a correction toward equilibria. Okay, so let's see, Fed funds here, EC1 has a negative coefficient, so it was below equilibria, and by this small coefficient goes towards equilibria. And here EC4, same, negative, so Fed funds below. So these are very interesting results for understanding what these variables do in the economy. And yeah, okay, so above equilibria, converging towards equilibria, I will have to go back and double check all these things, so to have a clearer picture of all the macroeconomic significance, but I'm very happy to give you this part 2 of this lengthy study of macroeconomic variables, and let's see next year if money supply will continue to go up, and if the Fed will cut federal funds, and then we will have higher inflation, and then the Federal Reserve will have to work back some of its interest rate decisions. From me, from my humble desk, it's all for today. That's all, folks. I wish you a very super great holiday, Merry Christmas, enjoy your time, drink but responsibly. I know that everybody likes a bit of spirits, good spirits in this Christmas season. We all need it, and we hope for peace in the world. And yes, see you soon. If you like this comment, just thumbs up, and see you in the next video. And yes, Merry Christmas.